All right, welcome to CoinCover. Today, we're diving headfirst into a massive power struggle that's playing out right now for control of the Federal Reserve. And make no mistake, this is about who gets to run the world's most powerful financial institution.
So you might be thinking, the Fed? What does that have to do with me? Well, let's get right to it. The person in charge has a direct impact on your mortgage, your credit card rates, basically the value of every single dollar in your pocket. So the real question isn't some abstract economic debate. It's this: who's going to be in control of your money?
Okay, so here's what we're going to cover. First, the power shift that's coming. Then, a quick look at who actually runs the Fed. After that, we'll get into the top contenders for the job, what their game plan looks like, and we'll finish with the big one. Is the Fed's independence really on the line? Let's get into it.
All right, Section 1. A power shift is coming. And yeah, the clock is absolutely ticking on what is arguably the most powerful financial job on the planet.
So check out these dates. Jerome Powell's term as the big boss, the chair, is officially up in May 2026. But here's the kicker. The decision on his replacement, that's probably going to be made way sooner, maybe even before Christmas of 2025. Now, technically, he can hang around as a governor till 2028, but let's be real, with all the political heat, that's probably not happening. The race is already on, folks.
Okay, on to our next section. Who runs the Fed? To really get what's at stake here, we got to understand the rules of the game. You know, who's actually calling the shots?
It all boils down to this magic number, 7. That's the Board of Governors. Think of them as the core leadership team in Washington. These are the folks with permanent voting power. And get this, they're appointed for 14-year terms. Why so long? Well, the whole idea is to protect them from the day-to-day political drama, so they can make tough calls without worrying about the next election cycle.
But wait, it gets a little more complex. When it's time for the really big decision, setting interest rates, the group grows to 12. And this is the committee that has a direct line to your bank account.
So how do we get to 12? Simple. You start with those 7 permanent votes from the Board of Governors we just talked about. Then you add 5 more votes from the presidents of the regional Fed banks around the country. Now, here's a key detail. The New York Fed president always gets a vote, because of Wall Street. But the other 4 spots, they rotate every year among the rest of the regional presidents. It's a system designed to get both a national and a local view of the economy.
And this group of 12 has a fancy name, the Federal Open Market Committee, or the FOMC for short. But forget the jargon. Just think of them as the people with their hands on the economic dials for the entire country. When they decide to raise or lower the federal funds rate, that decision sends ripples everywhere, hitting the interest rates on your mortgage, your car loan, your credit cards, everything.
And now for the main event. Section 3, the top contenders. To make this easy to follow, we're going to break them down into 3 types of characters. You've got the loyalist, the insider, and the reformer.
First up, meet Kevin Hasset. We're calling him the Loyalist. He is seen as the clear frontrunner, and his stance is, well, it's not subtle. He's not saying let's wait and see. He's saying I would lower interest rates immediately. We're talking aggressive, right-out-of-the-gate action, which would definitely please any administration looking for a quick economic boost.
Then we've got the insider, Christopher Waller. Now, he's already a Fed governor, so he's the ultimate insider, the steady-hand candidate. His philosophy? It's the complete opposite of Hasset's. He's all about not moving aggressively and fast. He wants a gradual, data-driven approach. The classic by-the-book central banker. And our third contender is the reformer, Kevin Worsh. He's a former Fed governor too, but he's not just talking about tweaking interest rates. No, he's calling for a full-on regime change. He basically wants to tear up the current playbook and start over, arguing the whole system is broken.
So this table lays it all out perfectly. You've got 3 totally different flavors. Hasset, the loyalist, is all about immediate rate cuts, but the big risk there, according to critics, is blowing up the Fed's independence. Then you have Waller, the insider, who is the safe, stable choice. No drama. And finally, Worsh, the reformer, with his radical plan to first sell $2 trillion in assets before even thinking about cutting rates. That path, it's a huge gamble, with the highest risk of just breaking the whole system. 3 very, very different futures for the economy.
Okay, so what does a new chair actually mean for policy? Let's get into the new playbook and what it would really mean for all of us in the real world.
Look, the change we're talking about here is massive. For ages, the Fed's one true north has been keeping inflation at a strict 2%. That's been job number 1. The new playbook, it basically says, we can live with a little more inflation. The priority would shift to pumping up economic growth and jobs. The goalposts aren't just moving, they're being carried to a different field. So, what's the agenda? Well, it's pretty clear. First, hit the gas with aggressive rate cuts to boost the economy. Second, you'd see the Fed and the Treasury working hand in glove. And the big goal there is to make it cheaper for the government to borrow money. We're talking about saving money on over $1 trillion a year in debt costs. But there's always a catch, right? The potential side effect is a weaker US dollar. And what does that mean for you? It means your trip abroad just got more expensive, and so did that new phone or TV made overseas.
Now let's circle back to that wild idea from the reformer, Kevin Worsh. He wants to sell off the Fed's mortgage-backed securities, or MBS. Okay, what are those? They're basically giant bundles of thousands of home loans. The Fed bought a staggering $2 trillion worth to prop up the economy. Selling all of that off? That wouldn't just be a jolt. It would be an economic earthquake. Mortgage rates would likely go through the roof, maybe even overnight. The entire housing market would be in for a massive shock.
And all of this brings us to our final and honestly most important section. This is about the battle for the very soul of the central bank. Is its independence really under threat?
Here's the bottom line: fear. And critics are not mincing words. They see the potential appointment of a known loyalist, not just as a policy choice, but as a deliberate move to take political control of the Fed. And they're using some pretty heavy language, warning that this could introduce maximum systemic risk to the whole idea of an independent central bank, one that's supposed to be above politics.
I love this analogy because it makes it so clear. Think about it this way. The Fed chair is supposed to be the captain of the economic ship. Their job is to use the navigation charts, economic data, to keep everyone safe. The big fear here is that the ship's owner, the administration, tells the new captain, hey, forget the charts, steer the ship this way because it makes me look good, even if that means sailing right into a hurricane.
So it all comes down to this one huge question. And honestly, the answer could define the next decade for all of us. Can a central bank really serve two masters? Can it serve the short-term demands of politics and the long-term health of the economy? Right now, nobody knows for sure.
Hey, if you appreciate these kinds of deep dives, no jargon, just straight talk, do us a favor and hit that like button and subscribe to the Coin Carver channel. It really helps us out. Thanks so much for watching.